The oil price spike of the early 1970s raised the alarm in OECD markets about the geopolitical risks of over-reliance on oil. This prompted a concerted effort to bring new, homegrown renewable technologies to commercial viability. But when pricing reform in the oil markets brought about a decline in oil prices in 1986, the renewables market was brought to its knees. In the US, tax credits expired, and politicians embracing a new era of low oil prices were not motivated to reform them. And as the oil price depreciation continued in the 1990s, Japan's Sunshine Program was dismantled and the baton was finally passed to Europe, where a few regional governments introduced support regimes for renewable energy on the back of environmental concerns. However, it was not until the Renewable Energy Directive in 2008, when oil prices were peaking once more at $97 a barrel, that the European Union put into place block-wide targets to support the industry. If history has repeated itself, an industry collapse is certainly what should be happening now. In 2016, the price of two key oil benchmarks, Brent and WTI, hit $27 a barrel, the lowest level since 2003. This was brought on by a supply glut caused by US shale boom and, of course, OPEC's reluctance to raise its own production and to lose market share, along with a lower than expected demand. If looking back, this crash is one of the most acute in the industry's history. If we consider just 2 years earlier, those same benchmarks were trading over $100 a barrel, and thus the 2014 to 2016 crash saw over 75% of the value of a barrel of oil wiped out in less than 18 months. By comparison, the last oil price crash in the 1980s, coming after a sharp decline in the oil price spike in 1973, saw oil prices fall by over 60%, but over 6 years. So why has the industry proved so resilient this time round? Well, the answer partly lies in oil's weakening influence in the power sector. Whereas in 1973 oil made up 25% of the world's power mix, now it represents just 5%, which means that renewables and oil are no longer directly competing in the power stack, and therefore any dip in the oil price has less of an impact on the ability of wind and solar to make a profit. However, while oil certainly does have less of an impact in the power markets than it did in its heyday, the wind and solar sectors would be unwise to underestimate the indirect influence of the oil on electricity prices. Unlike oil, coal and gas do directly compete with wind and solar power, and depending on the market, the price of oil can certainly impact the price of both of these commodities. This relationship is most evident in the case of gas. At one end of the spectrum, large Asian power markets such as Japan, China and South Korea source liquefied natural gas, or LNG, almost exclusively under oil index contracts. Here, the price of oil and gas are heavily correlated, which means that when the oil market crashes, gas prices are sure to follow. In fact, if you look at Japanese LNG prices, they've fallen over 69% since 2014. In the Middle East, Europe, which buys some of its gas under oil index contracts from Russia, Norway and some North African producers, and the rest is traded on liquid market hubs, and these are sourced primarily from domestic suppliers, effectively North Sea producers, and from Qatar and the US. Finally, in the US there's almost no direct correlation between oil and natural gas prices, and the plummeting natural gas prices we see in North America have far more to do with overproduction and domestic shale-driven supply than international oil prices. Significantly, renewable investment has continued to grow in all three of these markets. This suggests there is a second reason, other than the weakening oil power link, for the resilience of renewables this time round. The answer lies in the significant cost reductions that have been achieved by wind and solar over the past few years, and this means these technologies are now able to compete with fossil fuels on a levelized cost of energy basis. Onshore wind is, in many locations, at wholesale grid parity, an average cost of $45 to $70 a megawatt hour. And although, of course, this is heavily dependent on location, most studies conclude that onshore wind is now cheaper to build than new gas, coal and nuclear. Meanwhile, the cost of solar at $100 to $150 a megawatt hour is at retail grid parity in many locations, and indeed in some, solar PV is even competitive at wholesale grid parity. And we saw earlier last year a 200 megawatt plant in Dubai was offered on a power supply contract at just $59 a megawatt hour. Therefore, with the oil and gas majors slashing capex and dividends in an effort to cut costs, many investors are now looking to the clean tech sector as a safe haven from the cutthroat world of commodities markets. But the question remains, what happens when oil prices start to rise significantly again? I'd argue that by the time they do, renewables will have such a strong grip on the power sector that they may actually start to influence oil market dynamics. the hunted could indeed become the hunter. Therefore, it's not so much a question of how lower oil prices impact renewables, but more of a question of will oil prices recover at some point, and if they do, will that boost renewables even further?